Let's turn to the energy market. Crude oil is trading around $85 per barrel this morning. There's a live look at it, 85.28 right now. Oil prices, of course, are up about 20% so far this year, booking 3 consecutive months of gains and hitting the highest level since October of last week. Let's speak with an expert on where it could go from here. We're joined by Hussein Allidina, Managing Director and Head of Commodities at TD Asset Management. Thank you very much for coming in.
Thanks for having me.
So the narrative appears to be here that demand is stronger than the market thought a few months ago and supply is a bit softer. Is that your take?
Yeah, the market was quite bearish Q4 last year, particularly on the economy slowing and U.S. production growth. Lent to a material contraction in non-commercial positioning or speculative positioning. Guys were quite bearish oil, I think, heading into 24, and notwithstanding kind of the lack of weather, demand has come in stronger than expected, and supply, even in the U.S., is turning lower again.
What about Chinese demand, and how material is that on the oil price?
So in an aggregate perspective, Chinese demand is quite important, second largest consumer in the world. On a growth perspective, we haven't had material growth out of China in the last couple of years, partially a function of the COVID-related slowdowns. We're seeing improvement there as well. So that is adding, I think, some constructiveness to the picture. But globally, demand is looking, I think, better than expected. Demand estimates this year, starting the year, 1.2 to 1.5 million barrels a day. You're now seeing the sell side revise their estimates higher because economic growth expectations are improving, not just in DM, but EM as well.
On the supply side, how influential have been the production reductions at OPEC Plus?
Yeah, very much. So they rolled their production cuts from Q1 through Q2. They had the JMMC yesterday, no indication that they're going to be bringing any incremental production back near term. They meet in June again. I think if oil prices continue to average higher from here, you'll probably see them increase production. I think what's really, really important, though, is that the curve, the backwardation in the curve, underscores how tight the market is today, and I think they like a backwardated curve.
Explain to our viewers what a backward curve is.
Price of oil today is trading $85 a barrel. A year forward is about a $10 discount. That disincentivizes incremental production outside of OPEC.
Right.
OPEC has the barrels, they're getting premium for those barrels.
So what's your range over the next 6 months or so?
So I was a $70 to $90 per barrel guy last time I was on the show. I think we can probably creep a little bit above 90. I do worry that as we get above 90, you start seeing concerns about, will the Fed cut rates, at some point this year? Inflation expectations probably edge higher. I don't know that the consumer can handle $100 per barrel oil. 70 to 90 is still where I'm at. I think we're getting closer to the top end of that range. Geopolitics could send us above $90 a barrel. That wouldn't be great for the economy. But purely from a fundamental perspective, I think prices are probably fair where they are today.
Everybody hopes, of course, that the conflict in Ukraine comes to an end. Likewise, the conflict in Gaza, the one in Gaza perhaps may come to an end sooner. Israel says several weeks before it is finished in Gaza. There seems to be no end in sight in Ukraine. So just frame up geopolitics for us.
So it's a very, very good question. So Ukraine has actually increasingly been attacking Russian refineries with drones. You've lost somewhere between the numbers are between 500,000 barrels a day and 1 million barrels a day of refining capacity. This is actually challenging Russia's ability to produce as well, which I think is a factor that's tightening the market. On the Israel-Gaza front, unclear, hopefully ends soon. The risk there, of course, is if this intensifies and becomes more regional. There's reports about, the Iranian embassy that was attacked in Syria. Not sure where this goes. There's been no production disruption from that conflict, notwithstanding the humanitarian disaster. That could get ugly.
What about the Red Sea? The Houthi rebels at one point were impairing traffic in the Red Sea.
We've seen a tremendous amount of cargoes have to transverse the Cape of Good Hope through South Africa. The way I think about that is it's a new pipeline, so there's oil that's gone into that pipeline that's not making its way to the market. We're also seeing incremental demand because you're taking a longer route. That has played a role in tightening the market today. If that situation in the Middle East improves, you would see some relief, I think, if those waterways opened up again.
I know you track, of course, refining margins. What have we seen in refining margins?
Quite firm.
Very, very important.
Yeah, $25 to $30 a barrel. So this underscores Part of the tightness in the refining sector is these disruptions in Russia. There's some maintenance in North Dakota, some maintenance globally. But ultimately, it points to very robust demand. A $30 margin is a meaningful margin from a historical perspective. And importantly, between where we are today and the peak of summer demand in August, we see the demand from these refineries increase by, Energy Aspects quotes a 3 million barrel per day increase from where we are today. And that's why I think the market does continue to tighten fundamentally. The worry is, can the consumer handle gasoline at $2 a liter this summer?
Right. Oil prices feed into inflation in a fairly direct way,
yes,
i.e. the gasoline pumps. What are the dynamics that we need to understand there?
The volatility in inflation is primarily driven by energy. And in particular oil. This is why a lot of folks will have commodities in their portfolios to hedge against that inflation. If oil prices continue to increase, you will see pressure on inflation.